Imagine waking up one morning to a starkly different world. The familiar hum of the global economy has been replaced by a deafening silence, punctuated only by the panicked whispers of a financial system in free fall. This is not a scene from a dystopian movie. It is a plausible scenario that could unfold with breathtaking speed. In just 30 days, the intricate web of trust and credit that underpins our modern life could completely unravel. The economic foundations we have long taken for granted, built over generations of relative stability and growth, could erode beneath our feet, leaving countless individuals, families and businesses unprepared and profoundly vulnerable. This potential collapse is not a random event, but the culmination of forces that have been building for a very long time. We are living in an era that is irrevocably shaped by the consequences of choices made over decades. These choices, often made with good intentions by policymakers and central bankers, are now catching up with us faster than most people realize or are willing to admit. The slow, steady accumulation of debt, the relentless expansion of the money supply, and the deferral of difficult decisions have created a system that is far more fragile than it appears on the surface. What many fail to understand is that the tremors we feel today, the market volatility, the persistent inflation, the social unrest, are not isolated incidents. They are the symptoms of a much deeper, structural shift occurring within the global financial system itself, a change that threatens to redefine wealth, power, and security for the foreseeable future. The complacency that has settled over much of the developed world is perhaps the greatest danger of all. We have grown accustomed to the idea that economic downturns are temporary, that central banks will always step in to save the day, and that the system, no matter how strained, will ultimately bend, but not break. This belief, however, ignores the clear lessons of history. It overlooks the cyclical nature of economies and the predictable patterns that emerge when debt and financial imbalances reach unsustainable levels. The coming 30 days in this hypothetical scenario represent the moment when the accumulated weight of past decisions finally becomes too much for the system to bear, triggering a cascade of failures that moves too quickly for anyone to control. The purpose of this exploration is not to induce fear, but to foster clarity. It is to pull back the curtain on the complex machinery of the global economy and reveal the underlying mechanics that are driving us toward this critical juncture. By understanding the forces at play, the long-term debt cycle, the dynamics of money creation, and the historical precedents for such moments, we can begin to see the warning signs for what they are. They are not noise, they are signals. They are an urgent call to acknowledge the reality of our situation and to prepare for a future that may look very different from the past. The time for denial is over. The time for understanding and prudent action is now. What many observers fail to grasp is that we are not merely experiencing another turn of the business cycle. We are witnessing a profound structural shift in the very foundations of the global financial system. This transformation is being driven by two primary forces that have been gathering momentum for decades: unsustainable levels of debt and an unprecedented expansion of the money supply. These are not temporary problems that can be solved with a simple policy tweak or a minor adjustment in interest rates. Instead, they represent a fundamental challenge to the post-war economic order. They are part of a long-term economic cycle, a pattern that history has shown ends in a predictable and often painful way if the underlying issues are left unaddressed and allowed to fester. Debt, by itself, is not inherently bad. In fact, when used productively to finance innovation, build infrastructure, or expand a business, it can be a powerful engine for stimulating growth and creating tangible value for society. However, a critical line is crossed when debt begins to grow consistently faster than the income needed to service it. When borrowing becomes a mechanism to fund current consumption rather than productive investment, it starts to destabilize the entire system. Over the past few decades, and particularly since the global financial crisis of 2008, central banks around the world have responded to every economic slowdown by lowering interest rates and expanding the money supply. This was done under the assumption that it would revive growth, and to a certain extent, it did. But the hidden cost of doing so is now becoming painfully clear. We are now living through the late stage of what is known as the long-term debt cycle. This is the point in the cycle where debt has been piled up to such an extreme degree that it can no longer be effectively serviced by normal income levels. Central banks, the stewards of the monetary system, are now forced into a difficult and unenviable corner. They face a stark choice: Either continue to create money out of thin air to prop up the system, thereby devaluing the currency and risking hyperinflation, or allow the economy to deleverage naturally, which would cause severe economic pain through a wave of defaults, bankruptcies, and asset price collapses. Both of these paths have severe consequences, and neither is politically or socially palatable. Allowing a full-scale deleveraging would plunge economies into a deep depression, while continuing to print money risks, destroying the purchasing power of savers and wage earners alike. This dilemma is the central conflict of our economic era. It explains the erratic policy shifts, the market volatility, and the growing sense of instability that permeates the global financial landscape. The system as it is currently constructed is caught in a trap of its own making, and the path forward will require navigating between two very dangerous outcomes. Understanding this structural predicament is the first step toward preparing for what is to come. The result of the central bank's dilemma has been a dramatic and unprecedented increase in money printing. In just the past few years, the world's major central banks, most notably the United States Federal Reserve, have created trillions of dollars out of thin air. This was not done by printing physical cash, but through a more sophisticated process with the same fundamental effect. This practice, known as quantitative easing or QE, is essentially a modern form of monetizing debt. It is a vast monetary experiment conducted on a global scale, the long-term consequences of which are only now beginning to materialize. The sheer scale of this intervention dwarfs anything seen before in modern economic history, fundamentally altering the relationship between governments, central banks, and financial markets. Here is how it works in its simplest form. Governments issue bonds to fund their ever-growing deficits, borrowing money to cover expenses they cannot pay for through tax revenues. In the past, these bonds would be sold to private investors, corporations, and other countries. Under quantitative easing, however, the central bank becomes the primary buyer. It purchases these government bonds in the open market using newly created digital money. It's a closed loop that gives the powerful illusion of stability in the short term. The government gets the funding it needs without having to raise taxes or cut spending, and the central bank ensures that interest rates remain low, which keeps the cost of borrowing manageable for everyone. This mechanism effectively papers over deep structural problems. It allows governments to continue running large deficits without facing immediate consequences in the bond market, such as soaring interest rates. It props up the prices of financial assets, creating a sense of prosperity and confidence. However, this appearance of stability is incredibly fragile. By injecting massive amounts of liquidity into the financial system, central banks are not solving the underlying debt problem. They are merely transferring it onto their own balance sheets and, by extension, onto the currency itself. This process distorts price signals, encourages risky behavior, and ultimately creates a dependency on an endless supply of cheap money. The danger lies in the normalization of this policy. What was once considered an emergency unconventional tool has become a standard response to any sign of economic weakness. The system has become addicted to this monetary stimulus. The very act of creating money on this scale fundamentally erodes the value of that money over time, even if the effects are not immediately visible to the average person. It is a slow, silent process of currency debasement. We are witnessing a large-scale intervention that has postponed a day of reckoning, but in doing so, it has made the eventual adjustment far more significant and potentially more chaotic than it would have been otherwise. People often underestimate the danger of this kind of massive monetary expansion because its effects are not immediate or evenly distributed. The initial impact is not seen in the price of everyday goods like bread or milk. Instead, the newly created money first manifests in asset prices. We have seen this play out with breathtaking clarity over the last decade. There have been massive historic increases in the valuations of stocks, real estate, cryptocurrencies, and other financial assets. This surge creates a powerful and seductive wealth effect, making those who own these assets feel richer and more secure. They see their brokerage accounts and property values climb, leading to increased confidence in spending. However, it is crucial to understand that this is not genuine wealth creation. It is a wealth illusion. True wealth is generated by increases in productivity, by making more goods and services with less input. It is created by innovation, efficiency, and hard work. The inflation of asset prices driven by money printing does not represent an expansion of the real economy's productive capacity. Instead, It reflects an increase in the amount of money chasing a relatively fixed number of assets. The real economy, which is measured by things like wages, productivity growth, and small business output, has not kept pace with this financial inflation. This growing divergence is one of the most critical and destabilizing features of the current economic landscape. This divergence has fueled a dramatic and socially corrosive increase in inequality. The benefits of asset price inflation are not shared equally across the population. Those who already own assets, the wealthy, the property owners, the investors, benefit disproportionately. Their net worth skyrockets as the value of their holdings inflates. In contrast, the majority of the population, who live paycheck to paycheck and have most of their wealth tied up in their labor, are left behind. Their wages may rise slowly, if at all, while the cost of acquiring the very assets that are creating wealth for others, such as a home, moves further and further out of reach. This widens the gap between the haves and the have-nots, fostering resentment and social friction. Eventually, the inflationary pressures contained within financial markets begin to leak into the broader economy. It is a matter of simple physics. The money has to go somewhere. As the economy heats up and supply chains are strained, the cost of raw materials, shipping, and labor begins to rise. Businesses pass these higher costs on to consumers in the form of higher prices. This is when inflation stops being an abstract concept for investors and becomes a painful reality for every household. Suddenly, the cost of living rises faster than incomes, eroding the purchasing power of savings and wages. This is the point where the illusion of wealth begins to shatter, revealing the true cost of the monetary policies that created it. When widespread inflation does take hold in the broader economy, central banks are forced to confront the consequences of their earlier actions. They find themselves trapped in a dangerous balancing act, caught between two conflicting mandates: maintaining price stability and supporting economic growth. To combat rising inflation, the standard tool is to raise interest rates. Higher rates make borrowing more expensive, which cools down demand, slows economic activity, and eventually brings prices back under control. This is the orthodox response, the one prescribed by every economic textbook. However, in an economy built on a mountain of debt and inflated asset prices, this standard solution becomes incredibly dangerous. Raising interest rates threatens to pop the very bubbles that the central banks helped create in the first place. As borrowing costs rise, the entire financial structure becomes vulnerable. Highly leveraged corporations find it harder to service their debts. The housing market begins to wobble. The stock market faces a brutal repricing. In essence, the very act of fighting inflation risks triggering the deleveraging event, the cascade of defaults and asset collapses, that policymakers have spent over a decade trying to prevent. This creates a terrible choice with no easy answer. Do central bankers raise rates aggressively to crush inflation, knowingly risking a severe recession and financial crisis? Or do they pivot, allowing inflation to remain high and potentially become entrenched? This is the precarious position they are in today. Every policy decision is fraught with risk, and every path forward leads to significant economic pain. If they tighten policy, they hurt debtors and asset holders. If they ease policy, they hurt savers and wage earners. History shows that this balancing act rarely ends smoothly. More often than not, policymakers choose the path of least immediate political resistance. A deep recession and market crash are visible and painful, leading to immediate public anger. Persistent inflation is a slower, more insidious process. As a result, there is a strong political bias toward prioritizing short-term growth over long-term price stability. This choice only delays the inevitable and makes the problem worse by eroding confidence in the currency and institutions. What makes this particular moment in history so perilous is the scale of the problem. This is not a single country or a small group of nations facing these issues in isolation. It is a truly global phenomenon. The United States, Europe, Japan, and even many major emerging markets are all following remarkably similar paths of high debt and monetary expansion. For decades, the world's economies have become increasingly interconnected through trade, finance, and policy coordination. While this globalization brought many benefits, it also created a system where financial shocks and policy mistakes can spread across borders with alarming speed like a contagion. We are witnessing a synchronized, late-cycle dynamic that is unlike anything seen in modern economic memory. The interconnectedness means that a crisis in one major economic bloc can quickly trigger a domino effect around the world. For example, if the United States Federal Reserve raises interest rates aggressively, It doesn't just impact the American economy. It strengthens the US dollar, making it more expensive for other countries to pay back their dollar-denominated debts, potentially sparking an emerging market debt crisis. Similarly, a slowdown in China, the world's manufacturing hub, can disrupt global supply chains and reduce demand for commodities, hurting resource-exporting nations from Australia to Brazil. In this tightly woven system, no economy is an island. The vulnerabilities are shared. We are now at a critical juncture where the system as it currently exists is no longer sustainable. You cannot perpetually run large government deficits, borrow money to cover your expenses, and then print more money to cover that borrowing without facing severe consequences. At some point, the cycle must break. This point is often reached when confidence in the currency itself begins to erode. When people, investors, and even other governments no longer trust that the money they hold will retain its value, they begin to actively seek out alternatives. They look for stores of value that cannot be devalued by a central bank's printing press. This flight from currency is not a hypothetical risk. It is a well-documented historical pattern. It has happened countless times throughout history, from the hyperinflation of Weimar Germany in the 1920s to more recent examples of currency collapse in countries like Venezuela, Argentina, and Zimbabwe. People rush to convert their failing currency into tangible assets like gold and real estate or into more stable foreign currencies. What is different this time is that the world's primary reserve currency, the US dollar, is at the center of the problem. A loss of confidence in the dollar would not be a local crisis. It would be a global one, shaking the very foundations of international trade and finance. There is a pattern in history that becomes painfully clear when you study the rise and fall of nations over centuries. One of the most consistent and reliable markers of decline is not just economic instability, but severe internal conflict. When societies become deeply divided from within, when the gap between the haves and the have-nots grows into an unbridgeable chasm, and when trust in shared institutions completely erodes, the strength of a nation deteriorates from the inside out. This is not mere speculation or political commentary, it is the observable outcome when economic and political systems stop working for the majority of the people. Right now, we are seeing this dynamic unfold in real time across many of the world's most developed nations. Societies are fracturing along economic, cultural, and political lines at an accelerating rate. The wealth gap is now wider than it has been in generations, a direct consequence of the monetary policies discussed earlier. The top fraction of a percent of the population now controls more wealth than the entire bottom half combined. This extreme concentration of wealth by itself might not be enough to create systemic instability. However, when the majority of citizens come to feel that the system is fundamentally unfair, that the rules are rigged against them, and that their opportunities for advancement are disappearing, a deep and corrosive resentment begins to grow. That resentment does not sit still, it builds pressure under the surface of society, and eventually, it erupts. What we are witnessing today are the tremors of a much deeper societal shift. In many countries, and especially in those that have long been considered global leaders, the social contract between citizens and their institutions is under severe stress. This contract is the implicit agreement that if you work hard, follow the rules, and contribute to society, you will have a fair shot at a decent life and a better future for your children. When this promise appears broken, faith in the entire system begins to disintegrate. People lose trust in their government, in the media, in large corporations, and even in each other. This is the fertile ground from which populism, extremism, and social unrest spring. When people lose faith in the system, they eventually stop playing by its rules. This is how internal order begins to unravel, not always in a sudden explosion, but through a steady decay of civic norms and social cohesion. The economic hardship felt by millions is the kindling, but the sense of injustice is the spark that ignites the fire. The anger over unaffordable housing, stagnant wages, and diminished prospects is channeled into a broader rejection of the status quo. What begins as peaceful protest can escalate into civil unrest, and political disagreements can transform into irreconcilable tribal conflicts. This internal fracturing is as great a threat to a nation's long-term health as any external enemy. The internal decay is most visible in the plummeting levels of trust in the institutions that are meant to hold society together. Trust in government, the media, the justice system, and major corporations has fallen to historic lows in many Western countries. People no longer believe that their voices are being heard or that the rules of the game apply equally to everyone. There is a growing perception that a small, connected elite operates under a different set of standards, insulated from the consequences that affect ordinary citizens. When a speeding ticket is a major financial burden for one person, but a rounding error for another, the sense of shared fate and equal justice begins to crumble, creating deep fissures in the social landscape. This loss of faith has profound consequences for governance and social stability. When people stop believing in the legitimacy of their institutions, they are less likely to comply with laws, pay taxes, or participate constructively in civic life. Instead, they may seek out alternative sources of information and authority, often found in ideological echo chambers that reinforce their sense of grievance. We see this in the rise of algorithm-driven information bubbles, where facts are no longer shared but are selected to fit a predetermined narrative. When two groups of people can no longer even agree on the basic reality of what is happening in their country, democratic governance becomes nearly impossible. It is not just political dysfunction, it is a systemic breakdown in communication. History shows that there is a predictable cycle to this process of institutional decay. Periods of widespread prosperity often lead to complacency among the elite and the general population. This complacency allows inequality to grow as wealth and power become more concentrated at the top. This in turn fuels the rise of populist movements both on the left and on the right, which promise to overthrow the corrupt establishment and return power to the people. When the political center collapses under this pressure, extreme polarization takes over. Society breaks into hostile camps that view each other not as fellow citizens with different opinions, but as existential enemies. This is the stage we find ourselves in now. Civil discourse is being replaced by open hostility, and compromise is seen as a form of betrayal. Political debates have become tribal spectacles focused on scoring points rather than solving problems. This environment makes it impossible to address the complex long-term challenges we face, from unsustainable debt to climate change. The political system becomes paralyzed, capable only of short-term reactive measures that often make the underlying problems worse. The erosion of trust is not just a symptom of our problems, it is a primary driver, preventing us from finding the collective will to implement meaningful and necessary solutions before a crisis forces our hand. What makes this moment in history especially fragile is that this severe social and political conflict is happening in parallel with extreme financial imbalances. Economic hardship, when combined with social anger, is a highly volatile and explosive mixture. Stagnant wages, high inflation, unaffordable housing, and the constant threat of unemployment are not just abstract economic metrics, they are the lived, daily realities of millions of people. When individuals and families feel they are trapped in a game they cannot possibly win, no matter how hard they work, they eventually reach a breaking point. At that point, they may conclude that the only rational course of action is to stop playing by the rules of a system that seems rigged against them. This is how revolutions start. They do not always begin with violent clashes in the streets, but with a quiet and widespread breakdown of the social contract. It begins with the loss of belief. The belief that hard work leads to opportunity, that the system is fundamentally fair, and that children will be better off than their parents. This loss of collective faith is what truly destabilizes societies, not overnight but steadily and decisively. At the same time, there are growing calls for radical change from both ends of the political spectrum. While change is essential, radicalism can become dangerous if it is not grounded in practical, principled reform. Frustration can turn into destruction, and instead of fixing the system, we risk burning it down. One of the great dangers of this moment is that many people in positions of power and influence remain willfully blind to these powerful social trends. They remain intensely focused on lagging indicators like stock market performance, quarterly corporate earnings, and official GDP figures. In doing so, they miss the deeper undercurrents of societal anger and disillusionment that are building just below the surface. The signs are there for anyone willing to look: rising social distrust, the growing popularity of populist leaders, persistent street protests, widespread civil unrest, and an increase in ideological extremism. These are not isolated events. They are signals, loud, clear, and urgent signals that the system is approaching a breaking point. History is crystal clear on what comes next if these signals are ignored. Prolonged periods of intense internal conflict are often followed by civil wars, revolutions, or major regime changes that fundamentally reorder society. The specific form it takes varies from one country to another, but the outcome is usually the same: massive disruption, economic decline, and a painful, often violent, reset. This outcome is not inevitable. There are ways to rebuild the social contract, but they require humility, honesty, and a genuine willingness from all sides to bridge the divides. The cost of ignoring these internal conflicts is far greater than the cost of confronting them. Societies do not fall because they are attacked from the outside, they collapse when they rot from within. The world is undergoing a profound transformation, one that many people don't fully grasp because it is happening gradually but relentlessly. What we are witnessing is not just a temporary fluctuation in international relations, but a fundamental shift in the global balance of power. This is a structural reordering of the world system that has underpinned relative peace and prosperity for decades. These changes are not about fleeting headlines or the daily noise of politics. They are about long-term trends rooted deep in history, following a familiar and often dangerous pattern. Every great power, every empire, follows a predictable cycle of rise and decline, and understanding this cycle is essential to making sense of the geopolitical tensions that are intensifying around us. Every dominant power in history rises through a combination of strong leadership, technological innovation, superior education, and commercial competitiveness. Over time, it gains global influence through its robust trade networks, its formidable military strength, and its control over global capital flows. But eventually, the very success that brought it to the top plants the seeds of its decline. The nation becomes overextended, both internally and externally. Debt levels soar to unsustainable heights, economic growth begins to slow, internal conflict and social decay grow more pronounced, and its relative power inevitably begins to wane. Meanwhile, a rival power, often one that has meticulously studied the leader's successes and failures, begins its own ascent, building its strength and preparing to challenge the existing order. For much of the past century, the United States has been the undisputed dominant global power. It has held military, economic, technological, and cultural supremacy. Its currency, the US dollar, became the world's reserve currency, granting it an extraordinary and unparalleled advantage in borrowing and investing on the global stage. However, over the last several decades, some of those foundational advantages have visibly eroded. Massive debt accumulation, severe internal political polarization, and a relative decline in education and infrastructure investment have all chipped away at its foundation. At the very same time, China has been rising with astonishing speed, not just as an economic powerhouse, but as a formidable technological, military, and geopolitical force. This growing rivalry between the United States and China is not simply a competition over trade policies or diplomatic influence. It is a classic clash between an established ruling power and a rising, ambitious one. In the study of history, this dynamic is known as the Thucydides trap, named after the ancient Greek historian who observed that war was inevitable between Athens and Sparta because of the fear Sparta felt in response to Athens's rise. When a rising power threatens to displace a ruling one, conflict often follows. That conflict can be military, economic, or technological, or, as is increasingly the case today, all of the above. While a direct hot war is not inevitable, a new kind of Cold War, fought over influence and control, has already begun. Currency is now a primary battlefield in the global power struggle. The US dollar's dominance has long given America immense financial leverage, but that supremacy is under threat. As US debt grows and financial tools are used for geopolitical aims, other nations are seeking to reduce their reliance on the dollar. Sanctions and the freezing of assets have made the risks of dollar dependence clear. In response, countries like China and Russia are building alternative payment systems and increasing gold reserves. Major trade deals are now settled in local currencies, bypassing the dollar. These moves are deliberate steps toward de-dollarizing the global economy. As trust in the dollar fades, alternatives gain traction, slowly but steadily. A rapid decline in the dollar's status could trigger global market volatility and higher US inflation. The fight for currency supremacy is central to the broader contest for global leadership. The global order built on US leadership is fracturing. Globalization is reversing, with countries onshoring manufacturing and reconfiguring supply chains. The world is splitting into rival economic and technological blocs. Traditional alliances and institutions like the UN and WTO are losing influence. Emerging economies are demanding a greater voice and forming new blocs, such as the expanded BRICS. Nations must now choose sides or navigate between US and Chinese spheres. This creates a volatile, uncertain geopolitical landscape. The transition from the old order to the new is historically the most dangerous period. Success will depend on recognizing long-term patterns, not short-term noise. Those who adapt will thrive. Those who cling to the past risk being left behind. History reveals that economies and societies move in cycles, especially long-term debt cycles. Every 75 to 100 years, debt, inequality, and social tensions reach extremes that normal policies can't fix. At these peaks, debt is unpayable through growth alone, forcing major financial restructuring. The last major reset was in the 1930s and 1940s, ending only after massive government intervention and a new monetary system. Today, global debt is at record highs, interest rates have been near zero, and central banks are printing money to keep economies afloat. Wealth gaps and political polarization are also at historic levels. These conditions echo the past and signal another major turning point. Understanding these cycles is essential for navigating the risks ahead. Ignoring history leads to repeated mistakes. The patterns of credit, debt, and human behavior remain unchanged. We are entering another period of systemic reset. Learning from history is crucial for survival. Debt cycles are driven by numbers, but amplified by human psychology. During booms, optimism and greed fuel risk-taking and inflate bubbles. People believe good times will last forever, leading to reckless borrowing and speculation. When the cycle turns, fear and panic take over, causing asset prices to crash. Investors rush to sell, driving prices even lower in a self-reinforcing spiral. The worst damage happens when decisions are driven by emotion, not reason. Most people buy near the top and sell near the bottom, caught by the cycle's extremes. Recognizing where we are in the psychological cycle is key to making better decisions. Neither euphoria nor despair lasts forever. Understanding psychology helps navigate inevitable booms and busts. We face a rare convergence, the end of a long-term debt cycle, deep internal conflict, and a global power shift. Each force alone is disruptive. Together, they create unprecedented risk. History shows that when these cycles align, the world order is fundamentally reshaped. Financial restructuring is inevitable, straining households and governments. Social divisions make peaceful solutions difficult, fueling unrest and populism. Meanwhile, US-China rivalry accelerates global fragmentation and complicates cooperation. The move from a unipolar to a multipolar world increases instability and conflict risk. Clarity is essential. Denial only leads to repeated mistakes. We must study history's cycles as a practical guide, not just an academic exercise. The principles of debt, money, and power remain unchanged. Recognizing these patterns is the first step toward intelligent action. Only by confronting reality can we shape a stable future. The time to act is not when the crisis is fully visible to everyone, plastered across every headline and causing panic in the streets. By then, it is far too late. The real opportunity to mitigate the worst outcomes and steer toward a more stable future is now, while the system still functions and while meaningful change is still within our control. The path forward requires discipline, courage, and painful choices. There are no easy solutions or magic bullets that can undo decades of accumulated imbalances. We must focus on restoring fiscal responsibility, which means governments must learn to live within their means, reducing their reliance on deficits and debt to fund current consumption. This is a politically difficult but mathematically necessary step. Simultaneously, investment must be redirected away from speculative financial assets and toward productivity-enhancing parts of the real economy. This means rebuilding infrastructure, investing in education and technological innovation, and supporting small and medium-sized businesses that create real jobs and value. This is how a society generates genuine wealth and improves its long-term competitiveness. These reforms must be coupled with policies that address the root causes of inequality and social fracture. Tax systems must be made more equitable, opportunities in education and healthcare must become more inclusive and accessible, and corporate behavior must be realigned with long-term societal well-being, not just short-term shareholder profits. Rebuilding the social contract is as important as fixing the national balance sheet. This is a task that falls not only to policymakers, but to every citizen. We must demand more from our leaders, holding them accountable for long-term results, rather than short-term political gains. We must rise above the tribalism and polarization that paralyzes our political systems and engage in civil, fact-based discourse about the serious choices we face. We must educate ourselves about the economic principles that govern our world, so we are not easily swayed by simplistic slogans or false promises. Building a more resilient financial future requires a foundation of informed and engaged citizens who understand the stakes and are willing to support the necessary, albeit difficult reforms, that are required to secure a prosperous future. The future is not predetermined. History provides us with a map of the cycles, but it does not write our final destination. The choices we make in the coming months and years will determine whether we descend into a period of chaos, conflict, and decline, or whether we can navigate this transition intelligently and emerge into a more stable and sustainable economic future. The warning signs are clear for all who are willing to see them. The question is no longer whether the current system will be restructured, but how and on whose terms. If we act with wisdom and shared purpose, we can manage this transition. If we remain in denial, history will do what it always does, and it will not be forgiving.